Welcome to the Big Mike Fun Podcast, where you'll learn about advanced wealth building strategies from real estate investing to creating massive ROI and secured retirement profits. So pour yourself a cup of coffee, grab a notepad, and lean in, because Big Mike has got the mic. Starting now.
Welcome to the Big Mike Fun Podcast. I'm the Big Mike Zlatnik, and today it is my pleasure and a privilege to welcome Hannah Ott and Cam Benz from CBRE. Hi, Hannah. Hi, Cam.
Hi, Mike.
Hi, how are you?
I'm great. How are you? They hail from wonderful Indianapolis, Indiana, and they are a great team. So Hannah is a vice chairman at CBRE, and Cam is first vice president. And I met you through a mutual friend, Paul Keebler and Pepper Pike, and we both do a lot of business with Pepper Pike. So first of all, would you be so kind as to tell the audience a little bit about you, your family, kids, cats, pets, whatever works.
Absolutely. Yeah, so Hannah Ott, and I'm at CBRE, and I co-lead the multifamily team that's based here in Indianapolis. We sell properties all throughout the state of Indiana, and we have been selling some properties also in Michigan and Ohio. And today we're releasing a property in St. Louis with one of our awesome partners here at CBRE, and we'll be moving into the Louisville market as well. So we've got an awesome team of 11 people. We sell only multifamily properties. Our average size deal is typically $40 to $50 million, but with the breadth of experience on our team, we'll sell a property that's $5 or $6 million, or we'll do a $250 million portfolio. If it's an apartment community in the Midwest, then it's in our wheelhouse. We have a really experienced team. We've a lot of folks on our team that we've worked together a really long time. We're fortunate to have a really strong market share in Indianapolis. We sell anywhere from 60 to 70% of what trades in the state, depending on the year. And you said family, whatever. I married for will be 25 years this summer. I have two boys. Our oldest is a 21-year-old. Our youngest is 12, and that's about all for me.
Thank you for that wonderful sharing. Appreciate that. And Cam, would you be so kind?
Yeah. So Cam Benz. I'm a long-term Indianapolis native. Grew up in Indianapolis. Went to Indiana University for college and moved right back. So been here my whole life. So no kids yet and no pets. So it's a lot of time to broker deals and work on our team.
Cam spends awesome. All of his time selling apartments, which is awesome. Cam, keep all those things the same. We don't want you to have anything outside of real estate.
That's right.
Well, it's a great specialty. So I have to say, you can be a jack of all trades or master of none, and you are the kind of the specialist with multifamily Indianapolis, and you kind of dominate the market. And you are the biggest probably player in the market, which is really great. So people have to go through you in order to be able to get great deals to buy and sell. That's both. It's a beautiful thing, and it's probably also responsibility. So, but let's just jump into the market. So Indianapolis, Indiana, it's probably a steady Eddie, as predictable market as you get. And Midwest is just sort of known for predictable, steady Eddie. We've seen some volatility recently in some of the let's call them Sunbelt markets. So with interest rates haven't gone up so much so fast, some price corrections have taken place. If you go to Phoenix, some of Austin, a few other southern cities, it's pretty well known that those markets have seen some correction. How has it been in Indy?
Well, you said steady Eddie, and that is the way to describe Indianapolis. So we have been very steady and very strong for many, many, many years. But I will say over the last 5 years, Indianapolis has, especially the last 3 years, made its way onto charts that it never has before. It was, for the better part of the last 2 years, it was leading the nation in rent growth, and now we're like in the top 5. But in 2022, we saw double-digit rent growth, which is the first time, certainly in my 20-plus year career. And we have moderated. So our rent growth in Indianapolis last year was a little over 5%, which is very, very strong. at any time, but especially in a market where we saw rent declines in other areas. So Indianapolis is bolstered by a very diverse economy. We're not beholden to one industry. So we have a very diverse economy, which is very business friendly. Our state has I think it's a $6 billion surplus. So we are not hungry for dollars and taxing people in ways to get it. So it's very fiscally sound, very business friendly. And from an apartment standpoint, there's about 175,000 units approximately in Indianapolis. We're typically only building 3 to 5% of the base. So it's a very modest amount of new supply that comes, which helps with occupancy. What did I leave out, Cam, about Indianapolis or Indiana?
Well, what's been awesome over the last year or two is that, like you said, in the Southeast, they're starting to see rent decline and, more stress at the property level. And it's just not the case here in the Midwest, especially in Indianapolis. So it's been kind of fun over the last couple of years where we've been treated more as a flyover state, where people were going down to Atlanta and Florida, and they were doing very, very well on their sales. To where today, Indianapolis is actually still seeing rent growth, no rent declines, and feels a lot safer.
Mm-hmm. Mm-hmm.
Yeah, and I appreciate that sharing. I mean, that's the sort of my consensus, and it's not a long flight from New York. It's a fairly short flight. So
Yeah.
it becomes not a flyover state, but more of a investment opportunity. And I exactly what you said, that the rent growth has been steady, and I think there's been no rent decline for forever, for many years. But are you seeing? I'm just curious. I know it's a steady Eddie state. What transaction volume are you seeing right now? We're dealing with obviously much higher cost of debt, and this is the biggest hinder on the transactions taking place. The sellers would love to sell, but the buyers can't really afford the current rates. Of course, everyone is sitting, hoping and praying and expecting and projecting that the Fed will lighten up, the 10-year Treasury yield will drop, we'll see better mortgage rates, and hope is not a great strategy. We're still dealing with elevated rates of because inflation is not completely under control yet. And the worst part is this, I have to say this, that Fed has only one lever to pull. They push the rates up or down, and that's what happens, and it impacts the entire country. And some markets should be a lot more, let's just call them, I wish the interest rates would be more expensive in Phoenix and lower in Indianapolis, but it doesn't work like that, right? You're just experiencing the same, let's call it bad news as everyone else. Just curious, what are you seeing on the transaction side? What are your sellers are thinking, and what are your buyers are thinking?
So a typical year in Indianapolis, there's anywhere from 9 to 13,000 units that'll trade. So it's a very active apartment from a transaction standpoint. And that's largely because we have a lot of private owners. We have a lot of syndicators, funds that own in Indianapolis, and they'll trade every, 3, 5, 7 years. In the heyday, so in 2021, about 16,000 units traded, and actually the highest year is 2022. So even though interest rates went up, spring, summer of that year, there was still a lot of volume going into that year. Last year in Indy, only about just under 8,000 units traded. So about half of the year to, the average of the couple years before, but still a reasonable amount of properties did trade hands. So our volume was down to about half of what it was. Now that, when you compare it to what happened in the rest of the country, that's still good. That's still good volume. Looking at our pipeline for this year, our team will sell, on average 40 to 55 deals a year. We're right on track to be in that 50-ish range. Now it's January, so I'm making a lot of projections, but we've got 10 to 12 properties we're bringing to market in January and February. And so we feel like we are going to see more transactions this year than the year before, more in line with what would be a normal year, which would be, 10, 12,000 units trading in Indy.
So from a volume perspective, you hope things will normalize this year versus last year feels pretty slow. But what's happening with prices? are and folks that are bringing product to the market, are they forced to list at a discount to, well, I mean, it's all relative, right? From the peak, right? I mean, is there a price from the peak discount today? Southern markets a much bigger discount. Obviously, there's a big difference between a smaller property and a larger institutional quality property. Of course, supply demand for that is very different. So I'm just curious, as much as you can generalize, the product you're about to bring to the market, the stuff that's in the pipeline, how is it trading relative to the peak pricing?
It is a discount to where we were at the peak, and a lot of that has to do with interest rates. So that might surprise you that in 2020, so just this last year in 2023, our trailing cap rate for B or better product was still below 5%. Now, barely, it was 4.9%. That probably is going to look more like about 5% this year. And the reason that for the negative leverage to that level is people believe in rent growth in our market. So yes, prices today are lower than when they were at the tippy top of the market, but a lot of that had to do with interest rates and then elevated competition. We did a study for somebody recently that had owned the property for about 3 years. They bought the property like in 2020, and what the 2023 end of 2023 value was, the value kind of looked like this, meaning yes, let's say it was worth 50 million here. They bought it for 40. Let's say it was worth 50 million at the peak. It's still worth, 45, $46 million today. So it's still worth more than they paid for it a couple of years ago, but it's not as much as the peak. We probably saw prices come in, Cameron, like somewhere between 5 and 10% depending on the asset class.
Yeah, that's probably right. And there would only be a very short period of time where if you bought in the peak, you couldn't sell your property for what you bought it for today. In Indianapolis, that's just another thing that, like we were saying in the beginning of this, the highs are just not nearly as high, but also the lows are not nearly as low, where the price changes just and swings are just not as dramatic here as they are in the East Coast or Sunbelt.
Yeah, I appreciate that view. 5 to 10% is very, let's just call it light. It's nothing bad. With the cost of money going up so much, only 5 to 10% adjustment, it's almost, I won't call it insignificant. It's certainly the significance to this, but it's not, 20 to 30% in a number of other markets where it's already the norm. So obviously the negative leverage between the cost of money versus the cap rates that they're paying, all of this is just based on, like you said, it's the fact that there is good, consistent rent growth. And two, I assume folks are expecting the rates to come down over the next however many months.
Yes, and the other thing so the savior of the Midwest has been strong, steady rent growth and expenses that have not exploded like that has in coastal markets where maybe your real estate taxes or your insurance went up. And you hear about coastal markets where insurance costs doubled, tripled, quadrupled. We are not immune from inflation, certainly in the Midwest. And so we are seeing expenses, especially your variable expenses, your payroll, things just cost more from a repair and maintenance standpoint, but they're growing in moderation. And so are our rents, and your rents are your top line and your biggest number. So you're still having NOI growth even with expense growth. So what used to keep people out of our market, steady Eddie, not prone to the high highs, are some of the same reasons why even more people are interested in our market, is because following COVID and interest rate changes, the reminder that steady Eddie is not just okay, it's good, has been given to people in several different ways. And so it used to be 10 years ago, we're going to the National Multi-Housing Convention in a couple of weeks. 10 years ago, there were a lot of groups that just like, Indianapolis is not a target market for me. There are less and less groups that say that because Indianapolis has really been put on people's radar, and it's on the map, for people.
Yeah, and really what's happened, what's happened is in the Southeast, to win a deal over the past couple of years, you had to underwrite massive rent growth and your just kind of cash flows, where Indianapolis, you're underwriting, big pop in year one, but then There forward, it's 3-4%. In the Southeast, it's double that, or maybe even more. And people could get behind it because of the massive population growth. Now today, people are moving all across the country to build in those markets. That's preventing that big rent growth from happening. Indianapolis, almost all of our product is built by local Indianapolis developers. So everyone's aware of everyone else's projects. There's nothing really that surprises anyone. Our supply that's coming online is more than it is in years past, but not by that much, in all honesty. So we're not being hit with rent declines or big concessions or the problems down in the Southeast that are wrecking people's portfolio underwriting on top of interest rate increases.
And that makes a lot of sense. So as an investor, I certainly want to be in the steady Eddie markets, and Indianapolis is one of them. And the tax treatment, I think you spoke at the, when we were in Indy, you spoke at the lunch. Your system of tax increases is very moderate. The taxes don't go up the way they go up in many other states. Quick reassessment, which is absolutely great. Maybe you can comment a little bit on that. And then the other thing is just curious, how much of insurance cost increases you've seen? If you go any coastal market, anywhere you are in the natural disaster zone, those premiums are up, dramatically. I don't know how else to put it. In some cases, doubling and tripling if you're in a hurricane zone near the water. But you still, there's some natural. Does Indianapolis have any kind of natural natural disaster risks that can cause, I don't know, hail? I'm trying to think. What? Because you don't have tornadoes. Well, do you have tornadoes? The tornadoes show up.
Hail and the occasional tornado, yeah, but not to the level that where, like you said, where it's like a coastal market where they get hurricanes. But you mentioned two things: so taxes and insurance, which feels like death and taxes a little bit. But so real estate taxes, we are not a mark-to-market state. Assessed values trend the same whether your property sold or not, and so they are prohibited from chasing a sale. So all values are supposed to go up or down at the same time. We have seen increases in real estate taxes as the cost approach has increased, but it has still been modest, and it still has impacted all properties, not ones that sold. And I do think that actually keeps some people out of our market, because some people are just not willing to say, I'm going to buy a property for $100 million. It's assessed at $40 million, and it's going to grow slow and steady. They want to hit it one time in year, 2 or 3 for a big increase. And it just doesn't happen. It hasn't happened. Hasn't happened here. And so for those that want to underwrite that way, they're bidders, but they're not buyers because they aren't successful. In terms of real estate tax growth, from insurance growth, I'm shooting from the hip based on what we have seen in our recent valuations. We haven't seen tripling. I don't even think we've seen doubling, but we've seen taxes or insurance go from like $350 a door to like $450 a door, maybe even a little bit higher. If there's something at the property level, like some sort of claim or crime, it can be higher than that. What have you seen, Cam, in your VOEs?
Right. So the older properties that have had losses, especially or in lower locations, have seen much larger increases that could be closer to double. New construction has not been hit nearly as bad. One, because there is no loss history at all, but also because it has a lot of the, it's sprinklered or the fire prevention that you can use to prevent future losses, and an insurance carrier is more comfortable with.
Yeah, I appreciate you sharing this. So it's kind of a wave that hit the entire country, and insurance companies took advantage of it a little too much. In essence, it's good business to be in an insurance company when you can all in drove push the rates up, claiming it's a function of the losses, and that's what transpired. But hopefully, on a forward basis, that will stabilize. But let's go back on a forward outlook. So it's steady Eddie market. Tax increases they're not done mark to market the moment transaction takes place, which is good. Obviously, insurance everywhere, but not as bad as coastal market. Now, rent growth again sounds good. 5% per year. If you can do 5% per year, it'll beat the market for many years in a row. I think the norm is what, 3 to 2% or something like this, or maybe 4 to 3 or 3 to 4.
Depends on what time period you use. If you use a long time period, it's more like 3.5%. Use a 5-year time period, because we have a couple years in there of
Inflation, yeah.
extra, it looks more like 5 to 7%. But I would say our average rent growth here in Indianapolis is probably going to be more like 4%.
You know what's really interesting, and I'd love to hear your thoughts. We're certainly coming out of very unprecedented times. COVID was, a black swan event. It destabilized a lot of things, including what was steady inflation. Now it's kind of got out of control. It's coming back, hopefully under control. We all want to see predictable, steady prices. But there are some theories that inflation may be sticky. Things may be a little bit at this elevated level for longer periods of time. As a result, the rates may be a little bit at the elevated level. Hopefully not, but it's certainly a possibility. So do you think, if you have a project, if you are basically an owner and you're getting ready to sell, for whatever reason, you executed your strategy, is this time to consider doing something this year, or is it better to wait another year, wait and see, and just give a little more time? It's kind of one of these things where I know as a broker, you're going to tell them, hey, don't be shy, let's try the market. But at the same time, it's one of these things where if you can avoid, putting the property on the market at 24, wait until 25, you're probably better off, because the rates will be at a lower point. Maybe the country will sort of be at a better place. I don't know. I'm just curious your thoughts on the subject.
The answer is it depends.
That's right.
It's if you have done your business plan and you're at a place where you can sell the property and all you truly are waiting on is a difference in interest rates, it depends on your personal risk tolerance. If you can sell today and make the profit that you projected, it might make sense to sell. If you can sell today, make a profit, but you're chasing down more dollars and that's what's going to keep you up at night, maybe it's worth waiting. But if the question is the property is not performing well today, should we hold off, or should we sell now? I would say you probably want to stabilize the property if you want to maximize value. It just depends on the individual situation, whether if they have to make a decision today and it's refinance or sell, or if they have an option.
Someone asked me that question like about a year ago, and when he was maybe with, a year, 8 months ago, when it was felt even more uncertain, and they're like, who is buying and selling today? And I was like, the same exact people, and it's the same decision tree as it always has been when you decide to sell. When we tell you we think the property is worth $50 million, does that price meet your goals? So we sold a $90 million property last year for JVM out of Chicago. And they purchased the property about 10 years ago, and we sold it for $90 million this year. They bought it for $45 million. Well, $45 to $90 million is a good return over a 10-year time period. Had we sold that property maybe a year and a half before, it could have easily been worth $100 million. And so they could have said, oh my gosh, it was worth $100 million. We should have sold it then. That's not what they did. They said, I'd like to return some capital to my investors. I'd like to use this capital for other opportunities. It's a phenomenal return. And so it made sense for them to sell. So it's the same decision process of, does this meet my goals or does it not? And we don't know what's going to happen next year. And so we preach a couple of things. One, we don't buy listings. So we say, if we think the property is worth 100 million and they want 120, we say, hey, well, this is what you need to do to get to 120 million, but let's not just try it. Let's not take it to market. So putting a property on the market at the right price is very important for all parties involved. Most importantly, our client and the property. It's putting a property out at the right price. And the second is to sell in the string. If your property, as Cameron said, is not doing well and the pricing that we're giving you is not exciting to you, don't sell right now. We can help give you guidance on this, where rents need to be. This is what needs to happen operationally at the property, and provide a path to get to the price that you want to get to. And it's worth trying that. It felt like when we gave people BOVs at the end of 2020 and all of 2021, they almost always decided to put it on the market because the price was so compelling. So for a lot of people, we were giving them a BOV just 2 or 3 years after they bought the property, and it already was at their 5 to 7 year value. So they went ahead and sold. We're giving more BOVs now with less people deciding to sell because the price is not as compelling for them. So it's more of a return to a more normal hold time period as before.
Yeah, understood. And what you said makes a lot of sense from the point of view that the last few years have been abnormal. It's the inflation, the price inflation, rent inflation, everything else was kind of out of control, and things quickly changed. And now we're facing this uncertainty. And if you offer them yesterday's prices or last year's prices today, of course, people will sign up for that. Otherwise, they have to wait until the market cycles back. But what happens on a buy side? On a buy side, what are your thoughts if you're looking for a really good deal? And on a sell side, you're telling them, well, don't sell if you can fix the problems and bring it to the market in a better position. But the buyers want to get better opportunities. So it's kind of, if you're representing both, if you're both sides of the equation, how do you get a really good buy? You got to get a that desperate or at least motivated seller, and you're not seeing a lot of that. So I'm just curious, what are the thoughts on the buy side? How do you get these great deals where you're very comfortable paying the price because it's a great price based on the current data?
We were hoping you would tell us. I'm just kidding. Well, on the buy side, it's really the same thing. So a big trend that we're seeing on the buy side, though, is permanent financing right out of the gate. So a couple of years ago, we had a lot of people using bridge funds and debt funds with floating non-fixed rate debt because people did not have fear of rising interest rates because there've been so many years where interest rates had gone down. Right now, if anyone is selling a property and you can go out and get permanent debt, or you can assume an existing debt, or you have a bridge loan and you're doing upgrades and the plan works and it hits your return metrics and it satisfies your goals, that's a good deal for you. We've had so many people that have talked to us over the years that are looking for like this killer great deal. They usually end up not buying anything. And it's the people who have been focused on meeting their return metrics, and maybe that's a 7 or an 8 or a 9% return and a low to mid-teen IRR. Those people have done business, and those are the same people who bought deals in 18, 19, 20, and they became worth so much more. It's hard to time a market, but if you're always buying and selling deals that maybe look like single and doubles, you'll get some home runs in there because you don't know. When we sold you could have taken any property that we sold from 2012 to 2017, closed your eyes and just picked it and grabbed it, and it would have been a phenomenal deal because rents went up so much. People did not know that when they were buying those deals, but those that were active and always buying and selling got rewarded. And so it's easy to look like you're the smartest person in the room when everything goes your way. But when those people bought those properties, they probably thought they were like singles and doubles. And so those are the deals that sometimes do turn into home runs.
I agree with you 100%. The only challenge today for the owners who bought 21, 22, they're seeing some of that price adjustment driven by the rate hikes, and
hold on to the property longer.
Well, I guess that's the words of the wise, right? Hold on to the property longer. Make sure you focus on execution, and that's the best advice today. Don't sell, and get it to the point where it's stabilized, and give it a little more time. And yeah, I mean, the rates hopefully will come down, but it's still unknown, and the speed of change we don't know. We just know directionally, Fed announced that they'll do something in the form of easing next year, but how much, how fast, still unknown. And so appreciate you coming in on the podcast and sharing. What's the best way to reach out to you if you're a buyer or a seller of a property, or you have questions in general, you're an investor? How would they reach out to Hannah and Cam?
The best way to reach out to us is going to our website on CBRE, or you can reach out to either of us. Our cell phone numbers are online, or emails are hannah.ott@CBRE or cam.beds@cbre.com. But we're available anyway. We're brokers. We're always available.
That's right.
Yeah, I got you. So it's the website is cbre.com. Is there /Indy/Hannah/
If you go to CBRE.com and look for available properties in the Midwest, you will find us.
Got you. You
Yes.
guys you're coming up as number one player, so that's easy.
No. I'm not saying we're coming up as a number one player. I'm just saying if you're looking for deals that, like Cameron said, the CBRE website, it goes to the deal flow and you'll get listings there. And you'll get to see the rest of our compadres listings as well.
Yeah, and folks definitely got to come out to Indy. Every time I come out to Indy, I'm more and more impressed. It gets cold, but I'm used to cold. I live in New York, and cold markets don't scare me. But Indy is a beautiful city, and it's a very predictable, easy to understand. Like you said, it's a very business-friendly city of all cities. Well, many cities in the United States, but one of the better business-friendly cities. So
That's right.
thank you kindly. Appreciate you, and wishing you a great 2024. We're recording this in early part of 2024. Hopefully, we'll see some significant improvements in 2024. We all are waiting for after 2023, which has been as it's called, a difficult year. 2024 looks like it can't get any worse than 23. It feels like, who knows, right?
We can only go up, right?
That's right. Thank you.
Thank you for listening to the Big Mike Fund Podcast. To receive your copy of Mike's How to Choose a Smart Real Estate Fund book, head to BigMikeFund.com or visit Amazon and type Mike Zlotnick. Keep listening and keep investing Big Mike style. See you on the next episode.